Are home buyers getting exhausted with the rise of interest rates and the continued rise of home prices? Now, Realtor.com just came out with an article that they say home prices could become flat and even take a downturn this year. Now, thanks for tuning in. My name is Joshua. I'm a local realtor here in the Roseville and surrounding areas. And if you find this content useful, please leave me a like, subscribe, and even a comment just to let me know to keep making videos just like this in the future. Now, onto the article from Realtor.com. They say that homebuyers are hitting their financial limits just as prime home buying season kicks off this spring. The rise of just about everything are eating into their down payment funds. Now, mortgage rates, which have rose nearly a point and a half in this past year, are expected to keep going up throughout this year, and that is adding hundreds of dollars to the monthly payments of today's would-be buyers. Now, today's buyers are paying 30% more for houses than they would have just a year ago, and factoring in all the higher sales prices and mortgage rates. Now, most real estate experts believe that the higher mortgage rates will force price growth to slow down. Now, one of the key factors here is that the Federal Reserve, the Bank of Dallas itself, set off alarm bells when it warned of signs of a brewing U.S. housing bubble, as purchases arising from the fear of missing out can drive up prices and heighten expectations of a strong house price gains. Now, if we jump over to their article, this is the Federal Reserve Bank of Dallas, and I did a video on this earlier this week, but expectation-driven explosive appreciation, what they call exuberance, in real house prices has many consequences, including the misallocation of economic resources, aka money, distorted investment patterns, people becoming over-leveraged and buying too many properties, individual bankruptcies, and broad macroeconomic effects on the growth and employment. Now, this isn't just growth in the real estate market, this is the U.S. growth. Because think about how many businesses are tied to residential housing. Whenever this exuberance phase runs out, which we're going to get into here in a minute, that the market will start to self-correct and even crash. It leads to price growth that will become exponential or explosive, that results in the housing market becoming progressively misaligned from fundamentals until, this is key right here, until investors become cautious, policymakers intervene, the flow of money dries up, and the housing correction or even a burst occurs. So now what they are saying here is that when investors, which investors have been a huge buyer of properties, when investors start to become cautious and start to take profits by selling these properties, it is going to lead to market turmoil, meaning that whenever they sell, they dictate the market, just like in the stock market. When you see those big moves down or up, those are always the investors with the big time money moving the marketplace. And whenever they start to move, you know it's already too late, as prices get too high or prices get too low, causing a recession or even worse. So now let's look at what exactly is fueling this expectation market that the Federal Reserve is talking about, and is interest rates. One of the things are interest rates, and you can see here that interest rates are now at the top or even exceeding what we saw back in 2018. You can see right here that we had a little stutter, but it has been on a almost 90-degree rise since, what is this date? December of 20, just a couple months ago. This is a massive run that the investors have been expecting. Now, this is an article from SacAppraisalBlog.com from Ryan Lundquist, and he says that Redfin states that 19.4% of buyers in Sacramento are these big institutional investors. Now, John Burns says it's closer to 26% from that same period. And you can see this little graph that I'll get to right here, and you can see that whenever the pandemic happened, when we saw the sharp sell-off in the stock market, we also saw one here in the real estate market as well. But it quickly came back up whenever investors, these big institutions, found out of the change in policies from the debt forgiveness, the forbearance programs, as well as the massive stimulus going on. They were expecting and preparing for what we're seeing now with high inflation and beginning the start to the higher interest rate. You can see here that investors have bought up to 90,000 homes in the third quarter alone in the US. Now they are preparing and have been preparing for this moment of high inflation and high interest rates because they knew and they were predicting that the rise of these two together were going to price out basically everybody from the housing market, and they will be forced to rent the homes that these investors have bought at a higher rate. One thing I like to watch is the wage growth. I like to track this data to really see if we can afford all this price growth of not just the homes, but with inflation as well. So this is the chart, and this is full-time employee data from wage and salary workers ages 16 years and over. And you could see since 2014 we hit the bottom and our wages were on a very good increase, and the stimulus of 2020 you can see affected greatly our wage growth. But ever since then, you can see here we've had a sharp decline and it continues to go lower. Now, it of course could begin to flatten out and go back up, but if we see our wage growth begin to slow dramatically, as we have seen these past couple, or basically this past year, it is setting us up for something very interesting into the future, which these big time investors have been planning for. Now, if you want to take advantage by selling a property you either own at the top, please let me know. I'd be glad to help you out with that transaction. And until next time, I hope you guys have a good one. I will speak to you soon.